So there is a panel here, and by looking at this panel, you can also, understand, or at a glance, or look at the summary, you can find out that okay, yes, we can, in FIFO, these are the qualities of FIFO, or these are the qualities of LIFO. So this basically table panel A will, it serves the, as a summary for you to understand what are the differences in FIFO and LIFO. So don't learn it by heart, try to understand the logic here. Here it is. FIFO, cost of goods sold, is lowest because it's based on the oldest cost. When the costs are rising, it means when there are inflation. I'm just going to write an INF, which is inflation. In rising prices, FIFO, cost of goods sold, is lowest, and its ending inventory based on the latest one, that is why it is highest. So LIFO cost is highest, cost of goods sold. LIFO cost is highest. Why? Because lastly purchased. So it means most recent cost, which is in inflationary, in inflationary periods, the costs are always higher. But the ending inventory is based on oldest price, so ending inventory will be lowest, right? So let's talk about the opposite of inflation, which is deflation, or when the inventory costs are decreasing, then FIFO method is, it is the opposite of increasing one. FIFO, cost of goods sold, will be highest. Why? Because prices are decreasing, the oldest prices will be highest, right? So older should be sold first, so older prices are higher, so the cost of goods sold will be higher. So the latest ending inventory is lowest. Why? Because the latest prices are lower due to this decreasing inflationary periods. LIFO, because the oldest purchase will be sold first. So the latest purchases will be sold first. So latest prices are lower. So that's why cost of goods sold is lower, and the ending inventory is higher. Why? Because the oldest, so the older prices are higher. So this is the opposite of increasing, the increasing or inflationary periods. This is deflationary periods. And now, keeping track of perpetual inventory system. So the LIFO cost flow assumption does not follow the logical flow of goods. Why? Because we do not apply physically the LIFO or FIFO. This is just for costing system, playing with numbers. So it is impossible to apply LIFO unit cost to unit purchased and sold as transactions are happening. Weighted average cost can be quite challenging, requiring sophisticated computer software as well, right? So it's very hard to calculate because on every hour the prices are changing, every day prices are changing, right? For example, you buy, in the morning prices are different. You buy at the end of the day prices are different. So every time you are buying, selling, so it's really hard for you to calculate the average one. So some computer softwares are used to find out that one. Many companies track only inventory quantities during the period, so making adjustment entries at the end of the period apply either LIFO or weighted average. So many companies, what they are doing, they are not checking out the inventory on daily basis, or they are checking out after some period. And period can be different. For some companies, it is the end of the day, end of the month, end of the week, end of the 6 months, quarter, or year. So what we call is the The tax advantage of LIFO, and that is very important. When prices are rising, which is a normal scenario, so I'm going to just give you a tip. Write down LIFO. Start. LIFO means lower profit. And when you find out lower profit, you can develop the logic and you can just find out if profit is lower, tax is lower, right? If profit is lower, it means sale minus cost of goods sold. Which one is higher? So that our profit is lower, cost is higher, and our profit is low. So that we can say that cost of goods sold is highest. That's why our profit is lower and our tax is lower, right? While in FIFO, opposite of the LIFO, which means profit is higher and the normal circumstances is rising prices. And profit is higher if the profit is higher. And what is the reason? The cost of goods sold is lower. So cost, CGS, cost of goods sold, it is lower. When profit is higher, tax is higher. This is not in percentage term. It is in whole number. Let me just write it down here. Tax amount, not tax percentage. Percentage is the same, 35% or 40% or 20%. But in numbers, whole numbers, taxes are higher in FIFO, taxes are lower in lower in LIFO, right? And also just focus on the L of the LIFO: lower profit, lower taxes, lower ending inventory, right? And the opposite of LIFO is FIFO. You can just say that ending inventory is higher. So that is just for to give you a quick hint to find out that okay, you can have this logic as well. So let me just remove it here. So did you before removing, did you see that here that taxes are lower by using LIFO? So we call this advantage of LIFO. Let's discuss this. Let me just remove. It's taking too much time, huh? Sorry. Okay, so when there are prices that are rising, it results in lower taxable income, which I just told you here. Why? Because cost of goods sold is higher, and when we deduct other expenses, then taxable income is lower, and when you apply tax rate, so tax will be lower and net income also would be lower, right? So this advantage we call this, in other books we call this tax shield, tax advantage or tax shield from using LIFO. Understand? So on paper it shows lowest net income and you pay less taxes. When you pay less taxes, of course there is increase in hard cash, means cash is more available when you use LIFO, because on income statement this is a game of numbers that shows you lowest taxation, right? Compare the LIFO and FIFO inventory methods. So every method has its own pros and cons. So the LIFO, it provides up-to-date realistic net income. Why? Because in inflationary period, when the prices are rising, it assigns latest costs to the inventory sold, which is more logical. In that case, we see income statement which is based on realistic purposes. But when you see the balance sheet, balance sheet inventory contains oldest cost. It means balance sheet inventory is not up to date. While the FIFO, it provides more up to date inventory cost in hand. Inventory means inventory in hand cost. So it means latest costs are used to find out inventory on balance sheet. So balance sheet is more up to date, but income statement is not good. Why? Because cost involved, cost of goods sold involved, oldest cost in inflationary period. So those that we bought on higher prices, they are left in hand, and that you bought on higher prices, lower prices, they are sold at first. So that is why the recent costs are depicted in balance sheet. A managerial implication by using LIFO, which means there gonna be a manipulation of income when you use LIFO. It allows manipulation of income, which means when inventory prices are rising, right? When inventory prices are rising, large quantities purchased at the end of the year to lower taxes. What does it mean? It means when prices are rising, you switch your inventory method to LIFO. So it means when you sell an item, you allow the cost which is latest, which means cost gonna increase. When cost gonna increase, what happened? Profit gonna decrease, and you have to pay lower taxes, right? So liquidation can occur as well. Quantities decrease from last year. Companies must dip into older inventory layers. What does it mean? So if a company or business is having a bad year, management may wish to report higher income. How? The company can delay the purchase of high cost inventory until next year. So this avoid decreasing current year income, right? Because you're not purchasing at high quantity, so you are using the lowest price already on your system. You did not purchase, so you did not have a new purchases. So in this process, the company draws down inventory quantities. So this kind of practice is known as LIFO, inventory liquidation. The last one is that the LIFO is not allowed due to this manipulation. It is not allowed by IFRS system, but it is allowed under generally accepted accounting principle. These are two systems in the world. The US companies use GAAP, and the other companies they are use IFRS. So the agenda right now is not to understand the laws here. I'm just giving you information that it is not allowed under IFRS.